In this week's update, plenty of economic and central bank news to focus on in the final data push before Christmas, and a look back at 2021. No doubt about the big story this week in markets, and no, it's not Omicron, not yet anyway. The big story for investors remains inflation and the impact it's having on monetary policy. This week, we get a triple whammy with announcements from three central banks, the Federal Reserve, Bank of England and ECB. And there's a flood of other economic data too here in the UK, with the usual three-pronged data drop of jobs numbers on Tuesday, inflation on Wednesday and retail sales on Friday. Before we get to all that though, this is a good moment to look back at 2021 in the markets. Next week I'll look forward to 2022, but let's set the scene with a review of the past 12 months. It's been a good year for investors. The S&P 500 in particular has soared, up more than 25% year to date, which is impressive even if you strip out today's elevated inflation to arrive at a real return of around 20%. Other markets have done less well, but have still delivered what in most years would be considered a good performance. US small caps, for example, are 13% to the good. Here in the UK, the FTSE 100 is also up 13%. Europe is 10% higher. Asia has certainly lagged, with Japan only 4% up, and China and emerging markets, which of course are dominated by China, have really disappointed. China is 3% down year to date, and emerging markets are 4% lower. 2021, of course, has built on an already impressive recovery from the pandemic low in March 2020. Measured against previous post-recession rallies, this is right up there with the best. Perhaps not coincidentally, it looks remarkably like the recovery after the Spanish flu. Shares, at least in developed markets, have done well. So too have commodities and property. Both of these, of course, are traditional beneficiaries in an inflationary environment. And this is where the market story this year ties in with this week's central bank meetings. Inflation has the potential to derail the rally. I'll get to that in a minute, but first, the other key driver of markets this year, earnings. It's been another great year for corporate earnings as economies have reopened after the lockdowns between March 2020 and April this year. US earnings were 48% higher, clearly not a sustainable rate of growth, but an excellent recovery that's underpinned the stock market rally and kept valuations at a reasonable level. Earnings explain the geographic differences in performance too. US earnings have been much more impressive than those in other parts of the world, notably in emerging markets and China. The great performance of stock markets has been reflected in investment fund flows, as you might expect. Indeed, after lagging behind cash and bonds in the early stages of the pandemic, shares have more than caught up and have now cumulatively taken in more than those other safer asset classes over the past 18 months. That's the good news. The more worrying theme of the past year has obviously been the return of inflation, with last week's 6.8% reading in the US the most obvious sign of a deepening problem for central banks, albeit one caused as much by supply issues as an overheating economy. There are signs that the economy is running hot, with unemployment falling to historically very low levels, but the main driver of inflation appears to be supply chain issues, which have, for example, seen used car prices spiralling higher as frustrated buyers give up on finding a new vehicle in the wake of semiconductor shortages. So, the big question as we approach the end of the year is how central banks are going to withdraw from what is, by any measure, a period of extremely accommodative monetary policy. Interest rates have been kept extraordinarily low in the face of rising inflation. Indeed, if you factor in the impact of central bank bond buying too, the effective interest rate is massively negative. Central bank balance sheets have doubled in the past 2 years to a level that equates to nearly 30% of global GDP. Central banks are in quite different places when it comes to unwinding stimulus. Out in front now is the Fed, which has been the first to acknowledge that inflation is no longer as transitory as it previously thought. It's indicated that in response, it will now accelerate its tapering of asset purchases so that the programme is effectively over by March next year. That means we could see US interest rates rising from the floor by the spring. much will depend on whether currently waning inflation expectations are a sign that the peak has already been reached. The Fed will hope so. It could buy it some breathing space in the early part of next year. Anyway, this week will give us a hint of the thinking at the Fed. There's a press conference on Wednesday evening, our time, which will show us both some economic projections and also a new set of dot plots, the chart which indicates the expectations for future interest rates of individual rate setters. Importantly, the futures markets are still currently pointing to interest rates settling at 2%, which is less than the Fed's assessment of a neutral monetary policy. In other words, investors believe that the Fed won't tighten as much as it says, or that it will, but will have to change tack quickly because tightening unsettles the economy or the market or both. Here, the Bank of England is due to announce its final rate-setting decision of the year on Thursday, as will the ECB. It's likely that neither will raise rates, although there is more doubt about the Bank of England's decision, having indicated before the arrival of Omicron that it was ready to move. The ECB remains more cautious. Other data that will be under the spotlight this week in the UK include jobs data, inflation and retail sales, all of which are likely to make the case for rates to be lifted from the current emergency level of 0.1%. What is not clear is how much weight the bank will place on the government's increasingly apocalyptic commentary on Omicron. Like the more cynical among us, they may decide that the new variant has arrived at a convenient time for a government in desperate need of a diversion from its own problems. The trust issues facing Downing Street will come to a head on Thursday when a by-election in North Shropshire to replace the MP Owen Paterson, who kicked off the present integrity issue, has the potential to make life extremely difficult for a Prime Minister under pressure on all fronts. Apart from the central bank and economic data, things are definitely winding down for the holidays. Corporate news is thin on the ground, with just a handful of company results announcements. Home delivery service Ocado is probably the most interesting because its shares have suffered recently in the face of return to business as usual supermarket shopping. The key question now is whether a newly nervous population returns to online shopping in big numbers.